The buffer ETFs. The Holy Grail of retail investment management is to offer a single product which does two different things at the same time. It achieves high returns at low risk. But like a zoological hybrid half-beast, half-man, the result is a chimera or a monstrosity. Markets being what they are and human nature being what it is, I believe achieving the dual purpose in a single investable product is essentially impossible, or ill-advised, or just expensive. The reason it is axiomatically impossible in my worldview is that were this chimera widely available, all available capital would flow into it. That inflow of capital itself would raise the price of it and thereby lower the returns to all investors. Prices or costs would rise until such time as the high returns for low risk no longer existed. The fact that these two different things, high returns at low risk, are inherently contradictory does not stop the investment management world from trying to provide it. That's just how we get variable annuity monstrosities, which promise exactly the sweetest combination of high stock market returns but with moderate bond-like safety. The way in which these mythical half-beast, half-man investment products get sold is that the fees are very high and the liquidity is very low. A variable annuity is a roach motel that's easy to get into and hard to get out of. That's what typically happens when you try to combine the two goals into a single product. Anyhow, the year 2025 saw the rise of a new product called a buffer ETF, which promises to, wait for it, achieve high returns at low risk. We're doing this again. The Wall Street Journal headline from this past week on buffer ETFs is, "Are buffer ETFs too expensive for the protection they offer?" And here's a decoder ring on Wall Street Journal headlines. When the headline question is posed that way about certain products carried by major investment managers who may or may not regularly advertise in the pages of the Wall Street Journal, you should remember to just translate the interrogative into a declarative statement by shifting the verb to a different part of the sentence. It should have said, "Buffer ETFs are too expensive for the protection they offer." There, I fixed it for you. Now, it is still worth knowing about buffer ETFs, as the Wall Street Journal explains. They have attracted tens of billions of dollars of investment capital. As the Wall Street Journal further explains in the fine print after you get past the headline, the 1% fee is probably not worth it. You could achieve the same results yourself in a simpler manner. The article specifically states that in a side-by-side comparison of buffer ETFs with a balanced 50-50 stock bond portfolio over the past 5 years, the buffer ETFs achieved a slightly higher return at a slightly worse rate of volatility, which is their measure of risk, that took into account the higher fees, 0.7 to 1% on the ETFs compared to a balanced portfolio, which would be like 0.2% on average. Any comparison for a 5-year time horizon will be specific to the market returns of the time studied, the specific buffer ETF chosen for comparison, and the chosen ratio of stocks and bonds. As is almost always the case with an investment management world, you can choose comparisons that make things look better or worse. When you strip out the component parts of an investment management product, however, what remains indisputable is the cost. The buffer ETF offering is this. You can choose something like a 10% buffer ETF or a 12% buffer ETF or a 20% buffer ETF, which means you will get 10 or 12 or 20% downside protection against the stock market crash. If the market goes down 20%, and you have a 10% buffer ETF, the most you can lose is 10% on your investment because 10% minus the 20% drop is negative 10%. If you have a 12% buffer ETF and the market goes down 15%, you'll have just lost 3% that year on your investment because 12% minus 15% is negative 3%. This likely feels very comfortable to the retail investor. In exchange for that reduced loss, you cap your market gains. The market gains cap is proportional to your downside protection, although not necessarily mirrored. A 20% buffer ETF, because it protects you from a huge down market, should have a tighter, or that is to say worse, upside cap than a 10% buffer ETF. Since the 10% buffer ETF only protects you against the first 10% of loss, you can retain more of the upside. The band around your up and down returns can be shifted lower or higher to fit your view of what might happen, or more specifically, what you're afraid might happen. For institutional investors, these banded results, if necessary, can be efficiently achieved through options positions, specifically buying out-of-the-money puts for downside protection and selling out-of-the-money calls to cap the upside. This kind of paired put and call trading sets the band. The more you need to spend on market insurance by purchasing the put, the more upside you have to give up by selling valuable calls. Most retail investors should not be messing with options. They should stay totally clear of this stuff. So this narrowing result of a single ETF presumably seems attractive. In a reasonable presentation, hedge fund and finance theorist Cliff Asness of AQR Management expressed the right amount of skepticism about buffer ETFs back in September 2025. As Asness says, a simpler approach to hedging downside is to simply hold less equities or sell equities. My own version of that same advice would be only hold as much in equities as you can be reasonably certain not to need to liquidate for the next 5 years. The Wall Street Journal's earlier coverage on buffer ETFs in June 2025 pointedly quoted a Bloomberg analyst who called them boomer candy. What I called an impossible chimera, high returns for low risk, they call exactly what most retirees want. It's financial candy and not good for you. So what is the better way to achieve market returns while protecting the downside? The simplest thing is to own 2 mutual funds or 2 ETFs or some predetermined ratio. Maybe it's a 60-40 stock portfolio, maybe it's 70-30, 80-20, 50-50. I don't know. I'm literally not your investment advisor. What I do know is that you can create the proper result by owning a very low cost all stock index and then owning some very low cost all bond index. This will provide roughly the same result as a buffer ETF, but at a fraction of the cost. If your ratio changes over the course of a year, you can rebalance. Yay, you've got this.